Consumer Financial Protection Bureau released a report in May of 2014 titled Snapshot of Older Consumers and Mortgage Debt. It warns that mortgages and retirement don't mix. Are you among the growing number of retired or soon-to-be retired Americans that have more mortgage debt and less affordable loans? If so, you are at a greater risk of foreclosure than prior generations. So what's the big deal about having a mortgage during retirement? To begin with, your income typically falls during retirement, so you have less money to pay your mortgage. In fact, more than half of retired homeowners with mortgage debt spend 30% or more of their household income on housing. Unfortunately, home equity is a primary and sometimes only asset for retirees. Less home equity results in less financial security and greater financial risk. The good news is that about 80% of Americans age 65 and older own their home. Yet the percentage of homeowners with a mortgage rose from about 1 in 5 to nearly 1 in 3 between 2001 and 2011. The median amount those folks over 65 with a mortgage owed rose from $43,300 to $79,000 between 2001 and 2011. What can you do to protect yourself? The Consumer Financial Protection Bureau suggests 3 things to protect yourself and your home. First, know your mortgage payoff date. Sound budgeting and financial planning require that you know how much you still owe, what your interest rate is, or when the mortgage will be paid off if you just remain on your current payment path. If you don't know your mortgage payoff date, call the phone number on your monthly statement and ask your mortgage servicer. If you've been hearing about lower mortgage rates and decide to refinance, opt for a shorter mortgage term so your loan is paid off before you retire. Second, guard your home equity. As a result of carrying increased mortgage debt, many older Americans have accrued less home equity than their age group did a decade ago. Less home equity means less accumulated net wealth for many consumers. Consider other options like downsizing before taking out a home equity loan or doing a cash-out refinance. Third, know your retirement income and expenses. Most of us have less income when we retire. Run the numbers by doing a monthly budget before you retire, especially if you have a mortgage to pay. Here's a little tidbit to keep in mind. In 2011, older homeowners with a mortgage spent $800 or 290% more per month than their counterparts with no mortgage.